All right, you want to turn $50,000 into $500,000? This video is going to surpass every freaking expectation you have for making a load of money. All right, we have the no BS guide right now on exactly step by step. I'm going to go from phase 1, 2 to 3 and how to manage leaps, how to open, how to close, and how to flip your money into a lot more money. You're gonna turn a small pile of cash into a freaking big pile of cash. Bicep over tricep, all right? So look, I just wanna say, turning 50K into basically 500K is not easy, all right? So I'm gonna focus on risk management. I'm gonna talk about actually how to make this happen. And it's not gonna be overnight, all right? This is not a get rich quick. Although I'm excited, I'm very excited to show you how to do this. It takes time. It does not happen overnight. I started with a lot less than 50K, and my journey took a very long time. You can actually see here, this is my portfolio. This was back in 2020. Yeah, this was back in 2020, okay? And then, yeah, here's my portfolio recently, that 3.6 million. You already know if you're subscribed. Yeah, we've been growing that portfolio to some big bucks. And a small portion of my portfolio is LEAP options. But don't get me wrong, just because it's a small portion of my money, it doesn't mean that doesn't actually end up being a big portion of my returns, okay? Turning a small amount of money into a big amount of money is very possible. A little higher risk. Definitely some strategies that we got to talk about in this video, but absolutely necessary for small, medium, and the big boy portfolios, wherever you are, okay? So again, 10xing your money is a lot to ask. So keep in mind, I didn't say you could 10x your money in a day, in a week, or even in a year. It takes time. And we're gonna talk about doing this without taking an unhealthy amount of risk, because what good is it chasing all the money in the world if you have to be, stress doing it and basically, risking the money that you need for the money that you want. No. We're gonna focus on actually doing it without taking on stupid risk. We're gonna be smart about this. So it's very possible to 10x your money within a couple of years, maybe more, maybe less. I'm not a fake guru that's gonna say overnight, 6 months, 1 year. No, but 10xing your money is possible in a reasonable amount of time, and this is the fastest way to get rich. This is the best vehicle, hands down. Way better than any other vehicle out there, okay? LEAP options, in my opinion, are the best vehicle to do that because they give you that massive leverage, baby. They give you lots of leverage, and you get to put up a very little amount of capital to get the same results as a stockholder or even just a call option buyer who's kind of risking that short-term. They really need something to happen short-term when you're buying a short-term call option. With a LEAP option, you got time on your hands. All you have to do, buy it on the right stock. That's it. And wait. Buy it on the right stock and wait. Of course, I'm exaggerating. It's a little more than that, but I want to say that it's pretty simple, and let's get into the nuances and get into deeper into the LEAP strategy that I have for you. So regularly, stock shares, they move dollar for dollar. So if you have Microsoft and Microsoft's at 410 and it goes to 510, well, you made $100, right? I mean, that's $100 that you made. Cool, that's pretty simple, right? Anyone can understand that. My mom can understand that, my dad can, any beginner can. Right? $100 is $100, right? But with the LEAP option, you get to control 100 shares and you get to do so for a fraction of the cost. So you don't have to put up that much money and you still get to control 100 shares. And this is why it's leverage. Okay, leverage is super cool because leverage is the most important tool to become rich. There is no rich man or rich woman out there who has become rich just by their own time, okay? It's usually they're utilizing labor, capital, AI nowadays, and when it comes to scaling wealth, I mean, you have to invest using leverage. And leverage might sound like, okay, well, that's really risky, right? Sort of, kind of, not really. Okay, because look, when you take out a mortgage on a house and you put down 10% down or 20% down, or you take out an FHA loan or whatever, you put down a fraction of the cost of the house, right? Well, that's called leverage. You're not buying it 100% with cash. So leverage is a really smart way of getting rich, and all of the millionaires and billionaires, maybe not millionaires, but billionaires, they borrow money. They borrow money, and companies that don't need money still borrow it, like Apple's borrowing money. Why? It's because, well, leverage. Other people's money is huge leverage, right? But in this case, we're using financial leverage on a financial instrument that allows you to basically make multiple times your money if you are correct. So we're going to be talking about, well, how do you become correct? How do you jump ship if you're not correct? How do you manage leverage? Okay, so this is going to be one of the most financially rewarding videos that you can really watch. And LEAPS, if you understand LEAPS, you really understand options on a deep level. So as far as I'm concerned, this is one of the most important topics that you can study. And if you make it to the end of this video, you're also going to see how you can use LEAPS as leverage to also kind of transform into a covered call strategy. So for you guys that like steady income and passive income, LEAPS can actually be used not only for leverage, but also for safe passive income, such as covered calls, but instead of owning shares, using LEAPS. So that is something that we will cover later on in this course. But of course, I want to build up and I want to go step by step for a beginner to really grow that foundation, and then we'll kind of build up from there. Okay, so this is leverage. This is what it looks like. You have a little small ball, and then you can kind of be heavier than a big ball if you have a long enough stick, right? So like you can put like a mouse on this is a seesaw, right? If the seesaw is very, very, very long, a mouse can tip over a human being, right? That seesaw probably, I don't know how long it has to be, but yeah. A mouse can tip over a human on a seesaw if it's big enough, for example, okay? Well, what is a leap option? It's basically, the way I do it, it's a deep in the money leap. So I buy deep in the money leaps because it kind of replaces stock, okay? If you think about it, and I'll go over some examples using my portfolio as well. We'll actually open up and we'll go into an example very, very soon. Let's go over an example right now, actually. Let's open up my portfolio. Let me show you an example first, and then I'll go over more of my presentation, okay? So I want to show you NVIDIA because I have recommended NVIDIA at 115. This was a little bit of time ago. I recommended buying a leap option at 115, right? So now, of course, NVIDIA has gone up and that leap option was very successful. But I want to show you essentially a new play on NVIDIA, and I want to explain to you a leap. So a leap is essentially just buying a call option, okay? So if you buy a call option and a leap option, they're the same thing, except the leap option goes out very far in terms of date. So a leap option, typically it's 1 year. So right now, if I go for June 18, this is a leap option. This is going out over 365 days. So by definition, that's a leap option, okay? Now, if you were to buy 100 shares of NVIDIA, 100 shares of NVIDIA would be, $142, which is the current price of NVIDIA, times 100, it's $14,200. But instead, the most simple way you can understand this is if I go to the 100 strike price, okay? I chose 115 really, but I'll go to the 100. The 100 here is worth $53. So instead of 143, it's worth 53. So it's a lot less, right? So if I were to buy this leap option, okay, this allows me to control 100 shares of NVIDIA. The total cost here is $5,385 versus 100 shares, which would be, almost $15,000. So it's basically $5,000 versus $15,000, right? Ballparking the numbers. So essentially you're getting 3 times less, or 1/3 of the cost of buying NVIDIA when you're buying a leap option. Yeah, there's some specific reason for this. It's leverage, okay? You have leverage. Now, you do need to pay for leverage. In the case of a mortgage, you pay with interest or a fee, right? And I heard in Muslim countries, they're not allowed to charge interest. So instead what they do is they bake in a fee. So they say, hey, here's a flat fee, right? For their religious reasons, right? So in this case, it's kind of similar to that. Came to my mind because you're not really paying interest per se on this leap option, but you're paying a fee up front. So you can see here that the break even is 153, okay? But NVIDIA is 142. So yes, you're paying about $10 in terms of like a fee, or in terms of like a break-even amount that the stock would have to go up for you to break even, right? And we'll talk about the behavior of a leap option, because you can actually make a lot of money on a leap option, and it doesn't have to you don't have to wait till expiration. All the complicated stuff, you can just simply hold it, and when you're happy, you can take your profit and leave. So that's the nice thing about a leap option. It's very flexible. So you can get in, you can hold it for 2 weeks, 1 month, and we'll talk about that later on in this course. And then you can just take profit and go. So that's the nice part. So I usually buy deep in the money leaps with a high delta. So 0.75, 0.85 would be like the highest delta that you should really go for. You can also go for 0.7 delta. My sweet spot is 0.7. Here, my financial analyst wrote 0.75, 0.85 when he was making the slides with me, because 0.75, 0.85 is really kind of like that gold standard of you're replacing your stock. You're essentially owning stock for a fraction of the cost, right? At that point, you're basically moving dollar for dollar with the stock, okay? And what I mean by that is, again, going back to the beginning, when a stock goes up $1, you make $1, right? But with this LEAP option, when the stock goes up $1, you go up 85 cents. Okay, because the delta here is 0.85, and the delta really explains to you kind of how this option behaves. So when the stock goes up $1, the option goes up the same $1 multiplied by the delta. So if it's a 0.85 delta, then it's going to go up 85 cents. Okay, but here's the thing: when Nvidia goes up $1, okay, it goes up $1 on 142, which is like, you know, not even 1% return, not even like close to 1% return, right? It's like maybe half, it's like not half, but it's like 0.7% return, right? I'm ballparking the number, we'll put up on the screen right now. $1 divided by 142, it's about 0.7%, give or take, whatever this number is on screen right now. But with a LEAP option, okay, if it goes up 85 cents, here's our new formula. 85 cents divided by $53.85, right? That is going to be about 1.6% or so, right? This number right here is the answer. So the first ballpark estimate was 0.7, which I think I'm in that range. And this one is 1.6%. So it is more than 2 times the return. This LEAP option is better. It makes more than double the money for a $1 move in the stock. Okay? And that's simply because of leverage. You're making a little bit less money, but you're putting up so much less capital. You're putting up a lot less capital. And because you're putting up a lot less capital, you get a higher percentage return. Because if you buy $1 million house and you rent it out and it's like $10,000 a month, well, that's cool, right? That's 1% per month. But if you buy a $200,000 house in a kind of a bad neighborhood and you end up like renting it out and you get $4,000 per month on a $200,000 house, that's actually like a 2% return. Instead of a 1% return per month, you're doubling your return on less money because it's like a little bit higher risk. Well, that's exactly how like a LEAP option works. It's exactly like that. It's just a little bit riskier and you're getting paid a lot more for that risk. And a lot of investors and financial analysts on Wall Street, traders, okay, mainly traders are using this strategy. It's one of the smarter strategies. And one of the guys that I worked with on Wall Street was like, why would you even buy stock? Just buy LEAPS, right? That was like what he was saying. This leverage means that a 20% move in a stock specifically could result in like 60 to 100% move in your LEAP option, since it's like 2 to 3 times better, right? And oftentimes, I gave you a very simple example, but oftentimes it's a very skewed amount of money that you can make. So what I mean by skew is like, I just showed you an example of like a $1 move, right? But check it out. If Nvidia were to go up by 50%, right? 50% would be like $70. And I'm doing this math on my head. It's going to be right here, but I've been very, very good at math, so I'm going to be very close to these numbers. $70, to be specific, $71.25 would be like 50% return, right? Just so you know, a $70 move would basically turn this delta into over 90%, well over 90%. So let's just take the new delta because it'll increase as the stock goes up. So let's take this new delta of like 90, right? If the stock were to go up $70, 70 times 0.9, okay, would be about $63, all right? $63, roughly. This option would more than double. Okay, so a 50% move in the stock would more than double this option value, more than double, okay? So again, it's very lucrative if the stock goes up. The LEAP option just unproportionally makes a ton of money. It's skewed to make a ton of money, especially on the upside. So if like Nvidia doubled, this option position would be like, okay, so for example, last example, hope that you're enjoying this because I'm going at it from all angles so you have the deepest understanding of a LEAP option. So if this were to double, Nvidia were to go up by double, like $140, so the new price would be $280. That's a double here, but a whole 140 here would essentially be worth $240, right, total. So essentially it would be $280 total, so it would be $180 in the money And this option right here would be from $53 to $180. So it would more than triple. So it'd be more than triple. It would be like 3.5x or so. Yeah, by NVIDIA doubling, this would go up 3.5x. And by the way, I'm giving you an in the money option. If we go for an out of the money option, it gets very, very freaking wild. So let's go for an option. Let's say, like I said, NVIDIA goes to 280. If you buy an out of the money option, like let's say 200, right, for $10, and NVIDIA goes to 280, then it would be $80 worth. So $10 would turn into 80. So it would 8x. So it would go up by 8 times. So although NVIDIA doubled, this would go up by 8 times. So it'd be like 4 times more valuable, right? So basically it's just like an amazing leverage to be in LEAPS. I gave you a few different examples, but we're gonna go over some more real examples later on. But I want you to be aware of something. There's more benefits to a LEAP option. So one of the other benefits to a LEAP option is it doesn't really have to go up all this amount of money. It can simply go up a little bit and then you'll have a really nice profit on your hands and you can cut the position. Also, what's nice about a LEAP option is because time decay really kicks in the final, like you can see here how time decay is really, really strong in the last 7 days. It's also pretty strong in the last 30 days. So in the last 30 days, an option like really loses a lot of its value, right? But if an option has more than 100 days, like from 100 days to like 90 days, it's really not losing all that much value. And if you go out a whole year, its theta or its time decay, like the value of the option, if the stock does nothing, it's really not losing that much value. Okay, so a lot of people have that fear that, hey, if I'm buying call options, it's gonna lose a lot of its value. That is true. If you're buying short-term call options, you're at this part of time decay. So you're like losing a lot of money fast. But if it's over like 100 days, then you're really not losing that much money. So you're not really like racing against the clock with the short-term option, which can be very, very difficult to manage. You can also stack extra income by selling covered calls against your LEAP options, which is freaking amazing because a LEAP option already has like low time decay and you can actually use it similar to like a covered call. So the reason why you can use it similar to a covered call is actually because a LEAP option is so similar to like just holding stock. It's deep in the money. Because it's deep in the money, and by the way, deep in the money is like, again, 70 delta or 80 delta. Because it's so deep in the money, then essentially you can just sell calls against it because it looks like a covered call. That's a huge advantage of LEAP options. A regular stockholder, they would miss out on the premium of the income that they can generate because they're not usually selling covered calls. Where a LEAP option, not only can you sell covered calls, which you should be doing on regular stocks as well, but you're also selling covered calls on a lot less amount of money. So you could put up like a fraction of the money and you could still get the same premium through covered calls, which makes it an insane strategy to really leverage and build a ton of income and to just grow your account really fast. Also, what's nice is if you have a smaller portfolio and you can't really like diversify, LEAPS free up capital so you can diversify across more high conviction plays instead of like having to go all in on a stock or having one stock represent too much of your portfolio. What's also good is the risk is defined. So on a LEAP option, what you pay is your maximum loss, right? So like the premium that you pay, can't lose more than that. So it's nice because you know exactly like what you're risking. And then you also pretty much know like how much you can make and at what point you want to exit. And we'll talk about like exiting the strategy because truly with like buying options, it's really difficult to pick an exit point. So that's like a very important part of the strategy is like when do you exit and like how much do you make when you exit? So what is your profit target? So that's going to be like later on in this video once we cover all the foundation. I also truly believe that a LEAP option is one of the only few responsible ways of applying leverage with high probability setup and compounding cash flow. There's other strategies out there that use a lot of leverage, but to be honest, those strategies are very high risk, and a LEAP option I would put in the medium risk category. So it really is that sweet spot of having high returns without having too much risk. So let's get into the juicy stuff. LEAPS are long-term equity anticipated securities, typically options with expirations of 12 months or more. However, for me, oftentimes I'll consider a 6 to 9 month option also kind of in the LEAP category as it is long enough. And we don't care about definitions, we care about results. I personally use call options for just long-term bets. I like them because they let you control 100 shares. And the key for this strategy is buying deep in the money. So let's go over this example. So you can see here, this is Apple, okay? And then here is the option chain, and there's different options here, different strike prices. You can see 195, 200, 210, 220, 230, etc. This is more expensive, deeper in the money right here, and this is further out, more out of the money. So more in the money is going to just be more expensive. And that's why you can see here, we got a little bit cut off. There's no bid-ask spread here. You can't see, but this is the bid, the ask, and then the midpoint, okay? So essentially you can see how they're going from more expensive to less expensive. And that's because for buying a call option, the more in the money it is, the more expensive it's going to be. And the more out of the money, the less expensive. And that's because an option that's out of the money has a lower chance of expiring in the money. It's farther away. So deep in the money means a delta of 0.75 or higher, ideally around that 80 delta, 0.8. So high delta makes the option move almost dollar for dollar with the stock. The deeper in the money you go, the more intrinsic value the option has, and the less time value and less time sensitive. The less time value equals less decay and the risk eating away at your position. These behave more like synthetic stock. And what that means is it's a call option, but it behaves kind of like a stock. So that's why I call it synthetic stock, and that's the term that the option community uses. Here's an example. Instead of paying $45,000 for 100 shares of Microsoft, at $450, you might as well pay $14,000 for LEAP, controlling the same amount of shares, 100 shares. So there's massive capital efficiency, which is what allows you to scale a $50,000 portfolio into $500,000 faster. Now here's the stock selection rules. I personally only target high quality mega cap stocks that are leaders. So that's Apple, Microsoft, Amazon, Google, Tesla, Meta, Nvidia. These are the Mag 7, but there's obviously other stocks as well. Palantir, I've made a lot of money on, SoFi, lots of other good stocks as well that you can invest in. Personally, I would say no biotechs, please, unless you're a doctor yourself and you have a education in healthcare. Just stay away from biotech. It's way too risky and uncertain. Stay away from meme stocks. So a lot of these crypto stocks like the Riot and Mara, I'm personally not a fan of. So I would stay away from those. Definitely stay away from penny stocks. Penny stocks have awful options, very illiquid and just, very inefficient. And stay away from speculative junk stocks. And you should pretty much know what it is. If you have to ask, is this a junk stock? It is a junk stock, okay? So again, think about a lot of the Mag 7 stocks. Stocks with strong uptrends, so a stock that has a strong history like Nvidia, I'll show you right now on Yahoo Finance. I'm gonna show you Nvidia and how basically Nvidia continues to beat earnings. That's a very positive factor, right? When a stock continues to increase in value, have positive earnings, that's just a very good sign. So you can see here, 6 months. We've had a tough first half of 2025, so it's only 6%. But then if you look at the 1 year, it's 18%. And if you look at 5 years, that's obviously in the thousands of percent. So if you make a long-term LEAP option play, it may take some time, but if you pick a good stock, you can only imagine the sky is really the limit, especially for like a long-term stock that has a lot of upside, really. So stocks with strong uptrends, clean higher lows, and bullish long-term patterns. Higher lows just means like, let me show you here. So it's kind of hard to tell, but like this is like a low, this is a low, and like these lows, right? Although these are higher lows right here. So this is a higher low, this is another higher low right there. Now, obviously this is going back a long, long time ago, but a stock that continues just to make higher lows, like the lows here just continue to uptrend. So that's exactly what you're looking for. You're looking for a clear pattern, and you don't have to be a rocket scientist because a LEAP option has a lot of time. So you have time on your side with low theta. So it's very advantageous. If the current price of the stock is also very important, so you don't want to buy a stock at an all-time high. That is possible because some stocks continue to go higher, but typically you would want to buy a LEAP option at a strategic entry, which is just like a pullback. So I'll give you an example. This is not a popular stock and people think that I'm kind of stupid for this, but I've made like over $250,000 on Walmart. And that's because right here, when Walmart ended up falling down, I ended up buying a lot of shares. Bought a lot of shares, around these levels, $68. So this doesn't look that crazy, but like as the stock pulled down, I actually purchased it right here. Then the stock essentially had another pullback. So it went from like 95 down to 90 and like high 80s. I ended up purchasing more shares. So Walmart has been a very good investment. As you can see, like just the uptrend is very good. In the 1 year, it's up 45%. I mean, that's more than Nvidia. That's literally like an Nvidia return, right? So a lot of people overlook some of the less popular stocks, But for me, these are some of the core holdings that I have in my portfolio, in my Discord community, where I cover stocks that I don't cover on YouTube because they're simply too boring to cover on YouTube. People click off the video, it hurts the YouTube algorithm. I put in all this work for nothing. But honestly speaking, like if you look at less popular stocks, they can have crazy high returns as well. And that's just what I do off of YouTube, which is, reason to look into my coaching. If you're interested in that, it's the first link. But yeah, like look, if a stock is at an all-time high, I'd be very cautious unless for some reason you're still very bullish. With Nvidia, that can be the case, but for the most part, you want to see stocks that have pulled back. You want to strategically enter into them. You want to avoid stocks with just tons of regulatory or litigation risk. Companies that are in the fire, you really don't want those. You also, if there's a cheap stock, it has to have a story, right? You don't want to just buy a stock because it's just purely cheap, because that doesn't really mean that it's going to rise, right? So you still want to look for a turnaround story on a stock that has pulled back a lot. That's why a GameStop or some of those meme stocks were just bad to invest in. I never invested in those personally. Focus on consistent revenue growth, solid balance sheets, and dominant market positions, okay? Now, for dividend stocks, they aren't really ideal for this strategy because the yield that they get is not relevant to a LEAP option. Because when you hold the call option, you are not getting the dividends. So you don't really want a dividend paying stock. You want to have a high growth, more aggressive stock, because that's exactly what a LEAP option is for. So I'm looking for price appreciation, not dividends. I don't really care about dividends when it comes to LEAP options. Now, avoid the hyper volatile stocks that can drop 40% overnight. And that's pretty obvious, and that goes hand in hand with the junk stocks that I said to not trade. But don't get caught up in the game of just chasing premium. That is a huge mistake. I would highly recommend that you go for consistent results, consistency, even if it's lower return, versus chasing just those home runs. Home runs are cool and fun to do with a portion of your portfolio, maybe like 1-2%. But especially as you scale your portfolio into six figures, and you go from like 50K to 150K and 250K and 350K, you definitely don't want to be caught up in chasing some of the super volatile stocks that are inconsistent, because what will happen is, I've seen this over and over again, people will schedule a call using the description, right? They schedule a call, they're like, hey, I'm curious about the program, and then they'll tell me, hey, from your videos, Henry, I have made, $50,000. I turned 50K into 100K, right? Or more, right? I have a 150K portfolio. And then when we tell them about coaching and everything, like, oh, no, it's not the time, I'm gonna wait, etc., right? I'm doing okay by myself. And what ends up happening is oftentimes they will chase the high returns and they're on a high, right? As a beginner, you can sometimes get confused, right? It's like an 18-year-old girl that goes on a date with a multimillionaire who's 40, right? Like he's gonna tell her, yeah, baby, I want to get married, I'm serious, but that guy's not serious. He's 40 and he's just messing around playing the field, right? But that girl who's 18 is gonna be like, she doesn't know, she doesn't have experience. And same thing, funny example here, or crazy example, but it's the full truth. If you're a beginner and you have good results, you still got to know how to hang on to those results. You still have to understand that results are really built over a longer period of time. And especially when you're looking at turning 50K into 500K, it's really a journey, okay? So if you have a short-term sprint, we go from 50 to 50, cool, but I've literally seen people go to 150 and then all the way back down to 50K again, or even lower. They even lose money. And it's crazy because it can take you a year, 2 years to go from 50 to 150, 200, right? It can take years, obviously. And then you can just lose it in one crash. And I've seen that happen, especially like this year, certain people that were just trading by themselves, that were really cocky going into the bull run, started doing some leveraged ETFs, they just wiped out all their gains. And then they move on to the next shiny object syndrome. They go into real estate or some other type of business ventures. But hey, it's about being smart, and they wouldn't have quit if they had the right framework and they had the right long-term mindset. This is what I try to instill in my students. It's fishing for yourself and understanding the mechanics of the market. And that's why it's incredibly important for you to understand this strategy on a deep level, because this strategy will truly make you stupid amounts of money, but it can also wreck you in a crash. And that's why we'll be talking about risk management. And that's why I'm already setting up expectations for you to understand this on a deeper level, and not just oh, hey, okay, I get it, I'm out, and you're on to the next YouTube video. No, really understand this, all right? So let's go into the criteria, strike and expiration criteria. So I always buy LEAP options with 9 to 16 months of expiration. For me, 9 is good enough. It still gives me that low theta. So really, time is your ally, because anyone that's predicting the market week to week is a charlatan and a scammer. I mean, you can speculate you can make a fun content or fun video saying, yeah, I think this will happen next week. But in all reality, it is very difficult to predict the market week to week. So instead, try to predict the market in increments of 6 months, 1 year plus, right? Because you're looking to get rich over time. If you're looking to day trade, and I mean, that's, in my opinion, day trading is low IQ, desperate behavior for people that want to get rich quick, quick solution, and you just end up getting scammed, or you end up on that roller coaster of profits and losses that are just completely inconsistent, super waste of time. So, you're not even watching my content if you're a day trader. So doesn't make sense. You want to use time as your ally, and it is way more predictable to find stocks that have good fundamentals, good leadership, good balance sheets, financials, and then time is your ally. The longer the better, because it reduces theta decay, and you're essentially just owning stock for a much cheaper price with LEAP options. The deeper in the money you go, the more intrinsic value and the less premium wasted. So let me show you what that looks like. I'll go over an example right now. I'll open up Robinhood here, but you can use any brokerage, of course. Let me go into something as simple as Apple, okay? Apple is a typical boring blue chip stock, but I want to show you how a LEAP option is very, very powerful. I have some covered calls on Apple right now. By the way, if you're looking for income, then you should watch my retirement free course that I posted. It's in my playlist. You can check that out on this YouTube channel after you're done watching this, and you're taking notes on this. It's going to take you some time to get through this. But yeah, I'll leave that. It's in the playlist or in the description if you're looking to sell options. But yeah, let's focus on buying options. I have a covered call on Apple, but I'm also bullish on Apple long term. So honestly, like, buying a LEAP option is something that I would like to do anyways. So let's look at a real LEAP option that I would purchase. So yeah, the March 20th is far enough out. Now look, check it out. If you were to buy an out of the money option, like the 240 right here, it's going to be really cheap. But of course, you really need Apple to go up a lot. Like you can see here that, I mean, this is where Apple's trading at 202, right? Your break even is going to be 248. So, I mean, is Apple going to go to 248? Well, it's a little bit out of the money. Like you can see here how the chances are fairly low. But yeah, the option is cheap for sure. But as you go down here, the premium that you're paying is really not going to be wasted much. So for example, 240 has no intrinsic value. It has zero intrinsic value. So what is intrinsic value? It's the amount that the stock is in the money, right, on this option. This option is not in the money, it's out of the money. So this 885 is you're just purely paying for potential, purely paying for value that may happen, right? But intrinsically, it's not worth anything. There's no intrinsic value. It's only extrinsic potential value. There's no intrinsic value. So, this option is not preferred. Like this is not how I would go about it. Instead, you want to go for something like, say, the 180, because now, okay, the 180, it's in the money, right? So yes, it's a lot more expensive, but you have intrinsic value. So you already have $22.50 of intrinsic value. I got that from taking 202.50 minus 180. That's $22.50. So you already have $22.50 of intrinsic value. And yeah, the rest of this premium that you're paying is going to be extrinsic value. It's value that it may happen, right? It's time value and it's potential future value, okay? Now, you will see here that the break even it's very freaking reasonable. It's reasonable, 218. So can Apple go to 218? Well, yeah, absolutely it can. Can it go to 245? Well, it can, but the chances are much lower. And that option is going to be more difficult when it's out of the money. Now, this in the money option it's just way easier. Because look, I mean, your break even is 218, but as I said, you can also cut this position anytime that you want. So say, okay, for example, let me go and show you the Greeks here. Okay, the Greeks are the delta, the gamma, theta, vega, and rho. Okay, they're not super important. What's important is really the delta and the theta. Those are the two important ones. So let's discuss that. So look, let's say that Apple, let's not even be overly bullish. Let's just say in 1 month, okay, Apple has some good AI stuff or good news, whatever, what may have you, and stock just goes up $10, okay? The stock going up $10 will be a move in the option of $7.50. And that's because, the $10 on the stock is $7.50 since the option moves in relation to the delta. So if the delta is 0.75, then you just take the $10 and you multiply by 0.75, which is $7.50, okay? Now, if you look at $7.50 here versus the premium, it's actually a really big return because, 20% it's basically 20% return, okay? It's essentially 20%. And how am I getting that? Well, a $7 move on $38 is is roughly 20%. It's a little lower than 20, but it's almost 20%. I just know because 20% of 38 is $7.60, okay? So I kind of ballparking in my head real quick, good at math stuff. But yeah, 750 is almost 20% move. Now, how is it so high? Apple moved up 10 bucks, which is just a 5% move, just a 5% move on the stock. Well, the LEAP option is 20%. So it's like 4 times more. It's going up by 4 times pretty easily, right? I mean, that's pretty wild if you ask me. I mean, that's truly amazing. And I just told you it's in a month. So in a month, you can make 20% return when the stock goes up 5%. Like, you can see how attractive this really is. Like, in 1 month, if you make 20%, of course you can scale from 50K to 500K if you're picking the right stocks. 20% in 1 month compounded is like hundreds of percent per year, right? Because it's compounding. It's not 20% and then 20% on the same money, right? It's 20% and then 20% on more money, right? I'll actually put up on the screen right now, $100, 20% of that is $20, right? Like you can see right here, $100 times 20% is $20, so it's $120, right? But in the next month, you're getting 20% on 20. So 20% on 120 is now $24. So in the second month, you're not making $20, you're making $24. So now in 2 months, you made $44. So your capital is now $144. In the third month, you're now making 20% on $144. 20% of 144 is $28.80. If I'm doing my math correctly, you can see it on the screen, right? That's the third month. And here's what the fourth month would look like. The fourth month would be even bigger. And here's the fifth month. The fifth month, as you can see, is even larger. And this is called compounding. And by the way, here is year 15. So you can see how compounding works. It's really a chart of exponential growth. And at first it might start off a little slow, but compounding is really that magical factor. And you don't need 20% returns because obviously that's just not really possible every single month, or else you would become the richest man in the entire world eventually over time, right? And you can see that here actually. I'll go from 15th month to the 100th month, which is not even, okay, let's do 120 months, which is 10 years. You can see here how 120 months at 20% compounded would be a crazy unrealistic number. So that's how you know 20% per month is pretty much just unsustainable. But you can still get really good returns per month and you can become a millionaire, or just simply, for the title of this video, go from 50K to 500K in a reasonable amount of time, much faster than a majority of people that are working their asses off at jobs. And you should be doing that, but at a certain point, you probably don't want to do that, or just being a business owner is also difficult if that's what you do. So deep in the money leaps let me participate in upside while reducing downside decay. I only check the bid-ask spread and make sure that it's tight enough, because a leap option is definitely not going to have as much like tightness, because like look right here, 38 and 38.25 is actually freaking phenomenal. On Apple, it's really good bid-ask spread. The more tighter it is, the better, because you're minimizing the cost of basically a transaction, right? Although Robinhood is free in quotations, it's not really free, because every time you're trading, there's still like a cost, because bid and the ask, you're always going into the middle, right? So there's a market maker on Wall Street or an algorithm that's making money on you every time that you're trading. Robinhood selling the order flow to a third party. So be careful. You want to make sure that the bid and ask is fairly tight and less than $1 wide ideally. If liquidity is poor, meaning not many people are trading the option, oftentimes it can be best to just skip the stock, although all the blue chip stocks have really good volume. So yeah, let me go to my screen share real fast. Like Apple is amazing, so it has a really tight bid-ask spread. But you know, I've gotten a lot of questions about UNH recently because the stock has pulled down a lot. So I want to do like a little bit of a much different example than I've ever done before on YouTube. You can see here how the stock has completely been crushed, but this can be a very interesting opportunity to buy leap options. So you see it's down 37%, it's at $300. So if I go to trade UNH options, and then I go for an expiration date, let's say we're gonna go for June of 2026, we're gonna go next year, right? So if we buy a 250 call option right here, it's really going for very attractive levels. So it's $84 in premium, but you can see here how the bid-ask spread, again, it's a little bit wider, and that's because it's a less popular stock to be traded. And you can see here that the open interest is only $315. So in the entire history of this option expiring on this date, there's only been 315 contracts that have been traded. So it's a little bit more expensive on the bid-ask spread. It's definitely not ideal, but a $4 bid-ask spread difference is okay, considering that this premium is $8,000. So you're losing $200 on an $8,000 transaction. As a percentage, it's like 2.5%, 3%. So it's like a processing fee from any purchase that you make with a credit card. Not you, but the merchant. So when people purchase my coaching, I get a 3% fee right away from the transaction, whether it's PayPal or credit card or whatever. And that's, by the way, how Stripe and all these payment processors make a lot of money, including PayPal. But yeah, so right here, it's pretty standard. You're getting a 3% transaction fee. It is what it is, okay? So in this case, for UNH, this option does make sense. And the break even is 332. So if H goes to $400, then yeah, you have a value of $150. You get that by taking 400 and minus the strike price. The strike price here is 250. That's a $150 in value, right? And this option is 84, so you're essentially almost doubling your money. And UNH only has to go up 33%. So from 300 to 400 is 33% gain. Not even, it's a little bit less here. So it's like a 30% gain, okay? And yeah, this is an interesting option where you get a really nice return. Let's talk about position sizing. I have this little picture here for you. You can see here how 5%, 5%, and then little 3% and little 1%, different areas. It's important to have proper position sizing. You definitely don't want to put in too much into this strategy. That's why at most you see it's 5%. And these 5% would basically be in the biggest companies that you really believe in. Some of the ones that I cover on YouTube, NVIDIA to be exact. Here in this example, you can go 5% on Leap on NVIDIA and get some really good upside and end up doubling your money on a 5% bet. But you wouldn't want to go for like a 50% bet, because if the stock pulls down, then, I mean, look, you're trying to retire, right? You want to get rich for sure, right? You don't want to maybe get rich. You don't want to be on this type of roller coaster. You want to be with me, traveling, meeting me up wherever I am in the world, right? Well, I'm in Poland, I was in Moldova, I was in Estonia, I was in Dubai. You want to have a good lifestyle, right? Maybe for you, that's like being at the beach. Maybe it's a lot of my guys that I talk to that like fishing trips, right? We're simply just checking out Western Europe with their spouse. Like I had a guy I was talking to in my private client program where I helped them generate over $50,000 in 1 month. He said, yeah, me and my wife are going to Amsterdam, and then we're going to do the road down through France and then down to Italy as our final stop. So if you want to be kind of on that track, right, you can't go too crazy with the Leap options and too heavy into one position. You need diversity, which is why I drew this picture for you here. Now, with the 50K portfolio, I'd probably split it into at least 4 to 5 Leap contracts across different names. So at least like 5 names, especially if you're going for that higher return. But of course, like I said, 5% would be 10 positions here, right? So my analyst here who helped me with this slide deck, on the higher risk would be 4 to 5. We wrote together, but for me, you know, maybe towards 10. So keep this in mind though. If I had 50K to spend on Leap options, ideally, if you have 50K total in your portfolio, you really shouldn't be investing in just Leap options. So the title of this video is turning 50K into 500K. But of course, like if you only have 50K, then you shouldn't invest all of it into just this strategy. You should do some wheel strategy, some sell puts, covered calls. I have full free courses on all of those. Like you have all this information at your fingertips from me. This is stuff that took over a decade, and I've been perfecting these videos, and I spend tons of time preparing, researching, and editing these videos. You have all this for freaking free. Isn't that crazy? College educations are hundreds of thousands of dollars, and they teach you BS, nothing. This free course right now, if you take advantage of this, literally it's life-changing information, okay? So the reason why I say you don't want to be in one strategy is that's just simply poor risk management. It's just poor risk management. Even if you have diversity, if the market pulls down, then you don't have too much of a hedge on other strategies. So still got to know other strategies and manage your risk properly. Because if for whatever reason, like the stock market has another correction or crash, which is very unlikely, but nothing is out of the realm of possibility, the strategy is very high return, but can have poor performance during market volatility and market crashes and corrections. You'll be fine for the most part because Leaps have long-term expirations. And even like the Trump tariff situation only lasted a few months, and then the market ended up recovering, and a Leap option's 1 year out. So basically, even during tough times, you're fine, right? Like it's all good. Give you an exact percentage of your portfolio that should be put into LEAPS, because it really honestly does depend on your risk tolerance. Like I have certain people that I work with one-on-one and they have access to me anytime, and they message me and they say like, well, I'm feeling more aggressive, I got a raise at work, we made a ton of money, I want to put in, X amount of dollars into LEAP option. I say, for your situation, that's fine. And I have other guys that lost their job. They don't have a job anymore. They don't have any income. Option trading is all they got. So I'll say, hey, like, listen, we're going to have to go a little bit lower on the LEAPS. We're going to want to focus more on that consistent income option selling approach. It's hard for me to tell you in this general video without knowing you and your situation personally. So keep in mind that I'm giving you the basic rules that you should be aware of. So it's really up to you, your risk tolerance and what you're comfortable with. It also depends on your account size. Some people put 10 to 20%, some people put up to 50% of their portfolio into LEAPS. And here's kind of what it looks like. I'd say 50% is the most I go, because that's already pretty aggressive. Unless you have a small portfolio, then it's fine. Or if you're using options to really jumpstart your wealth and you're like, hey, I kind of take a more aggressive approach, and that's fine. So for a small portfolio, you can honestly be all LEAPS. That is fine. Usually we have good years in the stock market, and in 1 year you just double, triple your portfolio. For a medium-sized account, and these are relative terms, right? I mean, a medium-sized account, a billionaire, whatever. But let's say a medium-sized account is maybe around that 50K to 100K mark. Then you want to go like 50%. Now, if you're really in the big boy category, which is like multiple six figures, 300K or 400K or more, then you really want to start taking down LEAPS to 20% or less. So let's go over a quick example. Like basically, if I had my portfolio 3.6 million, I'm not putting 50% of my money in LEAPS. So like, are you out of your mind? Definitely not. Like, there's no point. And if you've already scaled, you're looking to generate income, so you're looking to reduce risk and just go boring retirement strategies. This is not really a retirement strategy. This is more so a high growth strategy for you guys that want some fast gains. So my portfolio is really too large for a 50% allocation. I'm really in that 5% category of just putting in 5% of my money. So let's make another specific example. Let's say you have exactly 50K and you're ready to deploy all of that into LEAPS. Well, for example, you go 14K in Microsoft, LEAPS, 12K in NVIDIA, 10K in Apple, 8K in Amazon, 6K Meta, and boom, that's a good bet right there. Of course, you can always leave 20-30% cash buffer for adjustments. You don't have to invest all your money. You can have some dry powder laying around and ready to deploy. So, this cash would give you flexibility if one position moves against you, or you see a killer opportunity. Hey, I love when my students spot a killer opportunity and they catch it. Fantastic, beautiful. Like I want to win together. I love that. Okay, so I personally never really risk more than 10 to 15% of total capital on any single LEAP option play at all, period. You don't want to go in that heavy. The leverage is very powerful though, and that's why it works both ways. Just want you to understand that. And a single bad earnings report shouldn't really wipe out your account, but it can definitely hurt. Also, a lot of guys ask me about stop losses and stuff. I want you to actually set a mental stop loss level or alert for each trade. And here's a really interesting diagram. Say that you have a stock right here, and then you bought a LEAP option when the stock was trading for around 100. And then all of a sudden the stock ends up, you know how this works, right? Oftentimes you buy a stock and it tanks right away. It's like almost like bad luck, but it's normal. It happens to all of us, and that's just the normal market. Let's say it ends up kind of tanking and then recovering a little bit, and then continues to, so it recovers. So it tanks to say 90, then it recovers to 95, and then it kind of has like weak performance, and time is going, right? It's been 2 weeks, 5 weeks, 8 weeks, and you're like, well, this thing is just going down, and the stock just starts going against you. I want you to set a mental stop loss. You don't want to be in this zone right here, the red zone. You know what I mean? It's just like kind of a goner at that point. This LEAP option has lost too much value and doesn't have enough time to even really recover. So in this case, you want to set a mental stop loss and cut your losses. So if you bought it for 100, it goes down to 85. Really just consider exiting the position and getting out and having that mental stop loss in place. Not a physical stop loss, but mentally you're going to say to yourself, I don't like this position where it's going. It's not in the right direction. I'm going to cut my losses right now. All right, let's talk about income stack and how to stack income. Bicep over tricep money. You're going to make your LEAPS generate babies for you, okay? You're going to send out your green soldiers, and they're going to come back with more green soldiers. And we're going to talk about income stacking using covered calls, all right? So here's how it gets spicy. A lot of the time, if I don't think the stock is going to really shoot up too much in the short term, I will sell short-term call options against my LEAP. This is called a poor man's covered call, okay? So I'm going to use NVIDIA. This is a recent example that I have made. I have purchased 115 call options in my Discord community last week, and we made 20% on LEAPS. Okay, now given that NVIDIA has gone up, I'm looking at the 120 call options. Okay, these call options expire June 18, 2026. Okay, so in this example, we have a 1-year LEAP. Okay, the delta here is 0.76. Open interest is great. Bid-ask spread is amazing. And if you personally like NVIDIA, this is a great way to own NVIDIA. Again, using less capital up front with the LEAPS approach. But now let's talk about and learn the strategy of selling a covered call option on a LEAP option. Okay, a LEAP option, given that it has high delta, it's in the money, is going to look similar to a stock. It's going to look very similar. It has the same kind of upside in many ways because it's going to be very sensitive to delta. So if the stock goes up $1, this LEAP option will go up 76 cents. So given that, we can actually sell a covered call. Since our LEAP option looks similar to stock, we can sell a covered call on a LEAP option. And this is called a poor man's covered call because it's a cheaper way. It's kind of like a back door into a covered call without having to really own 100 shares. You own 100 shares kind of via the call option, all right? So you don't have to, or you don't need to own 100 shares to sell covered calls. The LEAP option actually covers the sell call option and substitutes for the 100 shares that you would normally need to own in order to cover your call. How does that work? Well, let's say that you get assigned on your sell call option, then, well, this obviously depends on your broker as well. So I'm using Robinhood, you can use Schwab, you can use Fidelity, you can use Interactive Brokers. Yeah, all of that is fine. And normally your broker will automatically exercise your LEAP call option as well. So if it goes into the money, they'll typically close out both positions because they will recognize that the LEAP option is essentially a call option, right? And it's essentially 100 shares. So they're never going to kind of leave you high and dry by, it may happen, which is why we'll talk about managing the trade. I would never even leave it to the broker. So real quick, the broker will likely close out the position together. They will realize that it's a poor man's covered call. However, you just always close out the trade, and I'll show you why it's always profitable essentially to close out the trade. The only risk you have, you would always be taking profit anyway, so you never really have an issue. Let me explain to you using this chart, okay? Let me zoom in here. So look, let's say that you bought NVIDIA, right, this call options at 120, perfect. So 120, right? And then let's say that you sell a 140 call option, all right? So the 140 call option, we're gonna go to sell. And what you want to do is you don't want to sell it for June of next year. You want to collect income along the way, right? So you're going to sell a shorter term call option. Now, you're welcome to do it 30 days. You're welcome to do it 60 days or 90 days. I think all of that is perfectly okay in that 30 to 90 day window. I'm going to go for kind of like that middle amount right now in this example and show you a 60-day to expiration option, all right? This is like not monthly income, but it's income every 2 months, and it's freaking great. It's great. So say that I think NVIDIA is going to rise, but you know it's going to rise steadily to 150 over the next 60 days. So then if I think it's going to go to 150 and not that much higher, I'm going to sell the 150. And notice here in the chart, okay, I'm going to zoom into this chart right now. Notice that it looks great because you're going to make money even if it overshoots 50, but a little bit less money, right? It's gonna go down, but you're still in the green. And that's because the LEAP option that you have is very powerful, has a lot of delta, so it's increasing very fast in value. Whereas the short call option here, I mean, NVIDIA would have to go above 150, and even if it continues to go up, you're still making a lot of money on the LEAP option, but you're losing some money on the covered call that you sold, but you're still gonna be net positive. So if it goes to 150, just close out the trade. It's really as simple as that. You just close out the trade and you're like, hey, I'm done. And you're gonna make really, really fast, easy money. The benefit here is that a covered call, you collect income today, right away. It's only 2 months to wait. You still have upside, you still have a lot of upside, but above 150, you start to lose some of the gains that you were making, okay? So you're gonna start eating in to the premium that you collected, and you're gonna eat in to, you're gonna have some working against you. The nice part is the LEAP option, it has a higher delta. So this LEAP option here goes up in value quicker than this short call option goes down in value. So say like we're kind of like right here, and if NVIDIA goes up, the LEAP option goes up like this, and the covered call goes down like this, okay? So you're trading income for a little bit less on the upside. So you're selling your massive upside, okay? And you can also, you don't have to do the 150. You can say, hey, I'm not sure, maybe it'll go to 160. No problem. So go for the 160 then. So here, if you go for the 160, then you're gonna collect less income because 160 is farther out of the money. It's lower risk of happening, lower chance of happening, and traders are willing to pay less premium for buying this call option. So they're buying it, you are selling it, and you're creating income on your position. So again, you can see here, if I go for 160, then yeah, you truly have a good amount of upside, even more upside, and it's pretty hard to lose money here. You really almost can't lose money. Like even if NVIDIA were to shoot up a lot, you would still make more money on your long leap option. So this is like an easy way to collect some extra income at really no risk. And my recommendation, my opinion, not financial advice. I'm very experienced, but I'm not licensed, so I have to kind of like to say that. So you're aware of your own risk and you're making your own decisions. In my opinion, you should just take profit as soon as it hits the strike price. So if it hits, say, 160 in this example, just take a profit. You really can't lose it when it just hits 160. Just get out, take profit, and yeah, recycle the money into more leap options. Recycle that money into other plays. So freaking powerful strategy. So powerful. I don't know why I don't teach this more often. I do in my Discord, but on YouTube, I have a very limited amount, and in general, there's a limited amount of videos on Poor Man's Covered Call. Although I have a video, and I made a leap option video in my playlist. You can actually go to my LEAPS playlist. This course will be at the top, and then we're gonna have some little more videos under it. So if you want more education on LEAPS, I have more examples. Specifically, this NVIDIA example was a video that I will have probably second on the playlist, okay? So go to the channel, playlist, and then you will see the second video after the course will be the leap option example on NVIDIA. And it's like a little bit shorter of a video, but yeah, so check this out. Let's go over this chart right now, because this chart will help you understand the risk management and management of this strategy from open to close. When you open the strategy, great, you're excited, right? If the stock goes down, that's bad because a leap strategy is a bullish strategy, so you don't want the stock to go down. Of course, you want it to go up, and there's no strategy that wins in all scenarios. The strategy loses if the market goes down. That's why it's important to pick a good stock. NVIDIA is a good example, and I went over some of the reasons why NVIDIA in the second video of in the playlist under the LEAPS course. Check out if you want the why I buy NVIDIA, but it should be pretty clear. AI revolution, great company, great earnings, great management, high demand for their chips. All right, so no rocket science there. Now look, if it goes down, you're gonna lose money. You wanna get out as soon as it hits the lower end of your strike price of the leap option. So the leap option is 120. If NVIDIA falls down to 120, for risk management, you probably wanna cut at least, you wanna cut half the position. You can cut the entire position if you're completely scared, or half the position, right? So of course, no strategy really works in a down market, all right? The only strategy that works is buying put options and being in cash for the most part. Right, so that's the downside, all right? That's fairly rare, right? If you pick a good stock and you give it enough time, especially leap option because it has a lot of time, then it's likely going to do good things for you. So let's talk about the most likely case scenario, which is NVIDIA rises. So you can see here how if it rises to 140, you do want to be careful of assignment if you don't want to lose out on gains. So you may get assigned. You will unlikely get assigned super early, but in the last day, you have a higher chance of getting assigned. Or it may happen a little bit earlier if it's very high delta. But it won't be very high delta if it hits 140. It's not going to be super high delta. And because it's not going to be super high delta, your assignment risk is fairly low. And while the assignment risk is low, that's a good time to just take profit. This is a super easiest strategy because you buy it here, you sell the 140, it hits 140, you're out. It's as simple as that. You do a covered call at 140, hits 140, you take profit. And the 140 will be down slightly, but your leap option will be up a lot of money, and the premium that you collected will be also yours, of course. But this 140 might be slightly down. So if you're super mega bullish, do not sell covered calls. The poor man's covered call is a slightly bullish strategy. So if you think NVIDIA is gonna triple very fast, then just go leaps, do not sell covered calls. However, I will say, and you probably know this, that typically even bullish stocks move up, somewhat slowly. So in 2 months, they can rise, but they're probably not going to rise 20%. So it is smart to sell covered calls and use the poor man's covered call strategy. Even in a bull market, just go a little bit higher. So you can go for 150 or 160, right? Here I have the 140. As soon as it hits 140, you're out, all right? Because you don't want increased assignment risk. You don't want to have to deal with that, and you can just take quick profit and you don't have to wait any extra time. You take that profit and roll it into something else. In the case that you somehow get assigned, again, it's probably not going to happen, and even if it does happen, your broker will just close out both options, okay? But the chances are next to zero if it hits 140, which is your strike price, and there's still days left. The chances are near zero, so yeah, you're good. It'll either automatically sell, which is like that 1% of time, even less than 1%, or you should just close out the position. It's super, super easy here, okay? So I like to collect monthly premiums. The example I just showed you is like a 2-month, and I think that's perfectly fine as well, especially because a lot of people are busy. So if you're a busy professional, I have business owners, executives, IT people, lots of IT people, doctors, lawyers, medical professionals. You guys are busy, so you don't need to do weekly options. You can just do 1 month out or 2 months out, just like I showed you for an August expiration. So I like to collect monthly premium or even like quarterly premium. Here's a quick example, by the way, on Palantir. So Palantir, say it's at 120, Palantir is increasing in price right now. If you have a 100 LEAP, it's kind of like that same story. You sell a call option that's out of the money. So Palantir is at 120, you buy in the money, $100 LEAP, and then you sell a 130 call option expiring for next month. So the whole point of this poor man's covered call strategy is you have a high delta LEAP option, and then you have like a lower delta covered call that's out of the money. So you still have upside on the LEAP, and then you collect a covered call income. All right, so I target strikes about 5 to 10% out of the money to really kind of avoid assignment. And 5 to 10% out of the money also means that I'm making money and I have 10% more upside to make more money. So it's like money on money, money on money on money, all right? So, you're like Mr. Krabs from SpongeBob. You're like, I love money, all right? That's great. That's a great strategy, right? I hope you make a lot of money. That's my goal. My goal is to make you rich, make you more knowledgeable, and yeah, I love helping people. I enjoy what I do. And my work and part of how I get paid is coaching. And I love it because it's a win-win. I get paid to help people make money. We all make money together. It's freaking awesome. But my free stuff is better than everyone else's paid stuff. So I'm fine either way. I'm just happy to help. I love this stuff. This stuff is really amazing. And you should be using this strategy because, look, even if you want to go super safe, part of your money still deserves a strategy. This strategy is way too powerful to not use at all. So this income reduces my break even in the LEAP, by the way. So when you sell a covered call, you actually reduce the average cost of your LEAP. So yeah, it's amazing to do that. You stack premium, you stack cash flow while letting your LEAP option appreciate. And it's beautiful for compounding. It's a beautiful compounding strategy because premium income gets recycled into new trades, right? So you can use the premium that you collect, you can reinvest that into more LEAP options. So premium collected is really free money buffer. It's really kind of free money. Yes, you're giving up upside, but in this point of time, you make money and you still have more future money to make. You just have less massive upside, right? But it's all about consistency. So I'm not really trying to hit home runs all the time. I'm happy with small wins all the time. And if those small wins add up to, like, with LEAP options, you can make a lot. You can make 10% or more per month. So I'm happy with 4% a month, right? But with the LEAP option, of course, you're probably using it to scale. If you make 10% a month, that's fine. I'd rather make 10% a month on a LEAP option positions 12 months, like pretty much 12 months in a row, than like 30% 1 month and losing a little bit of money. It's not going to be that extreme, but you get what I'm saying. I like the little bit less volatility, and selling covered calls kind of reduces volatility a bit, and it kind of adds that consistent cash flow effect, which is really, really nice. So I like to call it kind of free money here. Here's like a little example that me and my team, my analyst here has. So the cost of LEAPS, and by the way, in my community, I have 3 coaches. And then in my one-on-one coaching, it's me and I have an assistant coach. So you have all the freaking help. You have like basically the best help in the world to succeed, all right? It's just not just me, it's my freaking team. We're all here together to get results. I love it because everyone is feasting. You're feasting. My team, they have jobs, they're feasting and they're helping people. I'm helping. It's just freaking amazing. All right, so let me get to the point here though. Cost of a LEAP, $6,000. The premium, $300. Let's say premium 2 is $200, premium 3 is $450, right? And what I mean by this is you have one LEAP option that you buy, but then you collect 1 month $300, second month $200, third month $450. All of a sudden, you have an amazing LEAP option that is making money. So by the way, this cost of the LEAP, maybe it is increasing the value. Maybe it's now worth $7,000, okay? And now you've collected all this premium as well, right? So you can think about it two ways. Either your final cost is lower, right? So if it's worth 7,000, then your actual cost is 5,000 because you've reduced it via selling call options. So now it's 5,000 average cost and it's worth 7. Or you can look at it, same thing basically, but you can look at it as it's worth 7,000, but you've collected some premium. So you're up $1,000 plus 300 plus 200 plus 450, which is the same thing. Either you've made $1,950 or you've made $1,950, right? So you can either look at your final average cost going down, or you can just treat the premium as income that you've made along the way. So it's amazing. It's amazing for reducing your cost, and or just amazing for making more money. So even if the stock trades sideways, that's actually preferred because you're making good money off of selling calls. But of course, the best is when it's like slightly going up. Let's talk about scaling and compounding. So as account equity grows, I slowly add new LEAP positions. So I add more LEAP positions because of course your wealth is growing, you have more money at your disposal, so you add more money to buy more LEAP options. You can create new cash from covered call income and it gets saved for new contracts and new trades. And once I got enough for another high quality LEAP, that's exactly when I basically use that capital and I put cash to work right away. So always protect your capital. Don't chase high returns, chase consistency, chase predictability and reliable income. And then with all this income coming in, buy more LEAPs and scale and compound. That's exactly how it works. It's as simple as that. Don't worry about FOMO. Don't listen to all the YouTubers there that are covering the hype stocks and the super exciting stocks and opportunities. You know, some are viable. I would say Tesla, SoFi, Palantir, Nvidia. Those are my top plays right now. But yeah, don't chase the super volatile stocks with this strategy because it's not going to be as consistent. Patience is really everything in compounding. If you want to go from 50K to 500K, patience is very important because one big mistake can really set you back, and the magic happens slowly, not suddenly. So avoid revenge trading or forcing new positions. I track account growth quarterly, and I rebalance as needed. So when your LEAP options make a ton of money, you should also be looking at reducing your position because it is easy to it can be easy to double, triple your money on a LEAP and then your position is a little too big. So it's also important to take profit. And that's kind of where exiting and rolling management comes into place. Once your profit target per LEAP contract has been hit, typically 100% or 200%, it is really time to take profit there. If a LEAP doubles, I seriously consider trimming and selling half that position to go back down to your original position. And if it triples, I mean, that's just time to go eat some lobster steak dinner or go to some omakase sushi or, have fun with your wife or your spouse and just kind of celebrate there. Rolling, by the way, means that you're selling your LEAP and you're buying a further out or higher strike LEAP. Okay, so you can also reduce your risk. Okay, let me go over this example. Say that you buy a 120 call option, right? And you made a lot of money. You've made, say, the LEAP option has made you a bunch of money. You had some covered calls that have made a lot of money along the way. It can be great to just close out the position entirely and then restart the position, except with that new anchor or that new long call option that's going to be higher. So if NVIDIA goes to 200, right, you don't really need a 120 call option. You can rebalance and go back up to something like 160 strike or 170 strike. So you want to really roll up, reduce your risk, because of course rolling up is going to be a lot cheaper. So let's look at this call option right here. So if I go to June 2026 again, yeah, just going from 120 and moving up to 150 here, you would essentially, save a lot of money. It says cost here, but that's because I'm buying this and I'm selling this, but it's really reversed because if I'm closing out the 120, I would be selling the 120 and then I would be buying the 150. So this would be reversed. And let me show you what that looks like just so you're not confused. If you had the 120 originally, you would sell the 120, so it would be worth more, and then you would rebalance up to 150. So if I rebalance up, for example, here, you can see I have a total credit of $1,500. So it's good to roll up and rebalance your position. And of course, cut losers early. So if it goes against you, again, you want to have that mental stop loss in place and just really take it. You don't have to be loyal to the stock. You don't owe anyone anything, right, in this world. If you're married, good to stay loyal, but you don't have to stay loyal to your stocks. You're not married to your stocks. You're not married to them. You do whatever you want. So a stock, don't get emotional with it. If you're making money, great. If you're not making money and the fundamentals have changed, get out of it. don't get tied up with it. Not your wife, all right? So you can get out of it. I do use trailing stops on LEAPS profits once I am up 150%. So if you're up 150, you can set a trailing stop and say, hey, at 170%, at 180%, I'm out. And that's fine. You can squeeze out a little bit more. It is okay to be a little bit greedy. It is all right. We're all greedy, right? We're humans. It's normal. It's natural. We want more. Don't get too greedy, but it's all right to be greedy. We're dealing with money here. We all want to make money. So it's all right to be a little greedy, all right? But just don't get too greedy. Set a proper stop loss if needed and exit the trade for a high amount of profit. No bag holding really allowed in this strategy, so you don't want to hang on and wait until expiration if it's not doing well. If it's not doing well in half the amount of time that you hold the LEAP option, it's a good time to just exit the LEAP option. And if a stock gets downgraded heavily or earnings crush it, just reevaluate. So if it gets downgraded, reevaluate how much has it gotten, how much downgrade is going to affect the stock, or if the earnings are good, hey, I'm happy, I'm taking profit. I'm going on vacation. That's fine as well, right? That's great. So never let a single LEAP position destroy 30% of your account. That's a huge mistake that I haven't seen anyone make, and I hope you don't make it, all right? So don't invest too much. We already talked about position sizing and risk management. And then last but not least, stay emotionally detached. Have many positions. Be diversified, and the strategy will work wonders for you. All right, guys, last but not least, if you want to make money, bicep over tricep. If you want to improve your option trading, you want to have me in your corner. I have very affordable coaching that can give you a fantastic ROI. I've had coaches in many areas of my life, and I am here happy to help you. So if you want to take the next action step, if you want to learn about either my Discord community or my one-on-one coaching, you can schedule a free call and learn more about how that looks like, if it's a good fit for both of us, and we have a quick free demo to show you how it all looks like, how the program is, and then we build your goals with you. And then, you know what? We execute on those goals. It's all about execution, okay? There's no such thing as a good idea. There's only good execution. Billionaires know that, millionaires know that. So let's make things happen. Go ahead, click the first link in the description, and yeah, let's chat. Let's work together if you want to scale up and improve your option trading. And yeah, super excited either way. We also have another in the LEAPS playlist. If you want to deepen your knowledge on LEAPS, I have I have a couple more videos here on my playlist. So yeah, go ahead and check that out. Either way, I am super excited. Congratulations for making it to the end of this course. I hope that you enjoyed it. I hope you had a couple of laps. I hope that you've taken some good notes, and I will catch you in my future videos. Make sure that you are subscribed. That's very important as you get all my videos as soon as they are out. Thanks so much, and have an awesome, blessed day, and I'll see you soon.